The top 20% of Americans will retire or are retiring with over $500,000 saved up for retirement. Now, if that's not you, don't worry. This information is still going to apply to you. In fact, I would argue it's more important to you than the top 20% because you do not have as many resources to work with. And I don't want you to run out of money or have to go back to work if you don't want to. If you want to go back to work, that's fine. But I just don't want you to have a retirement that's less enjoyable than you were expecting. If you don't know who I am, my name is Jeff Hanna. I teach creative personal finance strategies like mortgage-free life, financial planning-based tax mitigation strategies, things like that. And today, we're going to be talking about how much you will need to retire. So the first thing that you need to do is figure out your budget. Everything should start with your budget. You need to know exactly how much you're going to want to spend in retirement. Now, exactly is loose. And what I would do if I were you is I would take your current lifestyle and start analyzing it, okay? So the mortgage, cars, kids, etc. I would add everything up right there. Now, if you're doing mortgage-free life, you're not going to have a mortgage when you retire, but you're still going to have these other expenses. So the first thing to do, figure out your budget, current lifestyle, and then we need to start accounting for things. So when we talk about accounting for things, what am I talking about? Well, the first thing is going to be taxes. So we currently have 36 trillion of debt and we have 200 trillion of unfunded liabilities. If you don't know what unfunded liabilities are, that's Social Security, Medicare, government pensions, things like this. It's any promise a politician makes. So we have to pay for that, we being the taxpayer. Now, ask yourself a question. With 36 trillion of debt, 200 trillion of unfunded liabilities, are taxes going to go up, stay the same, or down in the future? In my opinion, I think they're going to go up, and a lot of people actually would agree with that. So that's the first thing to account for, 30 years of increasing taxes. The second thing is going to be inflation. Most people think of taxes as tax. Well, inflation is the silent tax, and that is eroding the purchasing power of your dollar. They are debasing the currency. Every 30 years, our dollar loses about 50% of its value. So if your lifestyle today cost you 10 grand, in 30 years from now, that same exact lifestyle will cost you 20 grand a month. I should put month right there. So think about that. The way you're saving for retirement right now, is that going to be able to keep up with 30 years of inflation? Now, the third thing is going to be something called long-term care. And long-term care is a little rough. I have personal experience with it in my family. A lot of people, have a grandparent or maybe a parent currently that's going through it. And here's the simple breakdown of long-term care. When you live a good life, you get old. When you get old, you may get frail or sick. When you get frail or sick, that's going to cost money. And this is things like nursing home, in-home care, things like that, right? And if we look at our inflation chart right here, let me erase my notes that were already on it. If we look at our inflation chart, long-term care in 1995 was $2,000 a month. In 2025, the average price is $9,000 a month. That's a $350 a month increase. Now, that is due to inflation, and then we need to talk about taxes as well, because long-term care is almost a risk multiplier, because you need $9,000 a month today to pay for it, but we have to pay tax. So we're going to have to gross a lot more than the $9,000. And then in 30 years from now, that number is going to double again. It could more than double too if healthcare trends keep going where they're going. Okay, so that's the third thing to account for. The fourth thing to account for is going to be market crashes. Now, the day I'm recording this video, the stock market's down 14%. That's year to date. Now, yeah, the stock market's going to come back long term. However, all of the rules change when you start pulling money out of your portfolio. So let's say that you retired right here when the market was down 14%, and then you took a 4% withdrawal. Well, now you're down 18%. The odds of coming back from that, very low. And what you're going to do ultimately when you retire into a down market and you're overexposed to the stock market like most people are, is you're going to run out of money a lot faster. And that's going to force you to rely on the government, aka Social Security. So unfortunately, market crashes, those are all based on luck. We can't control that. No one understands or no one knows where the stock market is going to go, whether it's up or down. Now, sure, there's indicators, and I know there's going to be people that say, no, I can predict the stock market. That's great. I'm jealous. So what do we do to protect against market crashes? Well, we put guarantees in the portfolio. Okay, and then number 5, pretty simple, lifestyle changes. So when you retire, every day turns into a Saturday and Sunday. You no longer have a job that you're at from 9 to 5, or if you're an entrepreneur, you sell your business, etc. So the lifestyle change when you retire, you need to account for things like maybe a country club membership, maybe a new car, maybe you want to travel, maybe you want to spoil the grandkids. It all depends, but you're going to be spending a lot more money than you expect. And that's the point I'm trying to get across in this video, is that all of these things to account for, you're going to be spending a lot more money than you currently think. Now, let's talk about Social Security for a second. Let me erase my notes again here. So, Social Security. The Social Security Trust Fund, we'll call this Social Security Trust Fund, is set to go belly up, bankrupt, run out of money by 2035, at which point in time, payroll taxes that fund Social Security are only going to be able to pay out 77% of scheduled benefits. So, how do we make up that 23% difference? Well, what I think is going to happen is that Congress, the government, whatever you want to call it, right, is going to lower the IRMAA threshold. Now, what is IRMAA? IRMAA is a surcharge on your Medicare premiums. Right now, it's for those of you that have done a great job at saving for retirement. However, in the future, what I think they're going to do is I think they're going to decrease that IRMAA threshold to where pretty much anyone making anything on top of Social Security is ultimately going to pay into IRMAA. IRMAA surcharge on your Medicare premiums. You pay a lot more for the exact same coverage, and I don't know about you, that doesn't sound very fair or equal to me. Then on top of that, we all save in 401ks. The problem with your 401k is that it's tax deferred. So then you need to figure out, okay, what are my options here? Well, I can do the STAR conversion, or I can do the Roth conversion. The Roth conversion is the expensive way. It's the most traditional way. You've probably heard of a Roth conversion. More than likely have not heard of a STAR conversion. STAR stands for Save Taxes and Retire. And with the STAR conversion, you can get a 20 to 40% discount on your taxes when you do it this way. Now, if you use the STAR plus planning, tax planning that is, and maybe that's something like a private equity purchase that can reduce taxable income by up to 50%. Maybe that's something like a leverage 179 deduction. Maybe that's something like a tax credit. I don't know, but maybe if you used one of those things, you could get an extra 20 to, 50% discount on top of that. So you're looking at paying maybe 70% less in taxes. This is not tax advice, this is not legal advice, and this is not a guarantee. These are just things that I've seen happen in the past. So move the taxable, figure out the best way to move the taxable accounts into a tax-free environment. So the whole point here is that you need to figure out exactly what your lifestyle is going to cost, and you do that by creating a budget. That's step 1. Then accounting for all those factors I talked to: taxes, inflation, long-term care, market crashes, lifestyle changes. And then figure out, okay, what's the most efficient way to save for retirement? Obviously, we know that's in a tax-free environment. So if you're about to retire, you can do a STAR conversion, you can do a Roth conversion. And if you're not quite there yet and you're still saving for retirement, really most people have 2 options, and that's going to be Roth accounts and life insurance. And that's why Mortgage-Free Life is so great, because Mortgage-Free Life, what Mortgage-Free Life does is that it increases cash flow twice. You can only increase cash flow one of 2 ways: reduce expenses or increase income. Mortgage-Free Life does it twice, because the first thing it does is it decreases expenses by paying off the mortgage, and then it increases income by creating a tax-free retirement. And I know a lot of people watching this video aren't going to need Mortgage-Free Life, but it's a very powerful program for those of you guys that do have a mortgage. So, hope you found this video useful, got some good information out of it. Hope you have a great day. As always, I will talk to you next time. Take care. Bye.